This chart shows Dubai's price growth curve flattening out alongside an important countermetric. In July 2026, daily transaction volumes still hit 1.03 billion dirhams in a single day. Headlines call a flatline a warning, but in this context, it signals market stabilization. Rising housing supply has balanced the scales between buyers and sellers, creating a mature equilibrium rather than an impending crash. What has ended is the era of guaranteed overnight returns. The days of buying a property anywhere on the map and flipping it for a massive profit 6 months later are over. The GCC landscape is now a multi-speed environment. Different regions and even different asset classes within the same city are operating on completely separate growth cycles. This environment divides buyers into 3 competing profiles. There is the yield seeker, the capital growth chaser, and the budget-conscious micro-investor. The core dilemma you face right now is a trade-off. You have to choose between immediate rental income in a stable market or locking up your capital for years to catch future appreciation in emerging zones. Applying a blanket strategy to the entire UAE is a guaranteed path to underperformance. In 2026, you have to tailor your approach to match specific scenarios. This scorecard breaks down the numbers. On the left, Dubai's ready market is generating average residential rental yields of 9.06%. The trade-off is capital efficiency. You need maximum upfront cash, and with the market stabilized, short-term capital appreciation is limited. If you want income outside of residential real estate, Grade A office spaces in premium business districts are drawing heavy attention. Multinational corporations are actively expanding their regional headquarters, running right up against a very tight supply of vacant premium office space. But these commercial assets are heavily priced. The barrier to entry here typically requires deep institutional-level capital. Back on the residential side, rental demand stays high due to simple macro factors. The population keeps growing, and prime locations have limited houses available. Developers are also adapting by building slow-living communities. By focusing on green spaces and wellness rather than raw density, they sustain premium rental values. Buying ready properties is a strictly defensive play. It works if your priority is immediate stable cash flow over aggressive portfolio growth. If you are chasing growth, look at the construction sites. Off-plan properties now account for roughly 71% of all home sales in Dubai. This maps the financial mechanics driving demand. Off-plan sits in the high appreciation sector due to a lower buy-in price and staggered payment plans. The trade-off is zero immediate rental income. Your return depends completely on the developer's capability to execute on time. The clearest targets for this strategy are major infrastructure corridors, specifically the 128 billion dirham expansion of Al Maktoum International Airport. Historically, when the government commits massive spending to infrastructure, the surrounding districts, like Dubai South, see localized, decade-long property appreciation. The secondary infrastructure play is industrial. Regional logistics networks are expanding rapidly to adapt supply chains. These industrial and logistics assets offer a resilient alternative for investors who want to step outside the residential market entirely. Off-plan and infrastructure plays are bets on future execution. They require liquidity to be locked up, patience, and rigorous project selection. While Dubai enters normalization, the market down the coast is operating at a different speed. Abu Dhabi is entering a phase of rapid acceleration. A primary engine of this capital growth is the 100 billion dirham Marsa Al Saadiyat master development, aimed directly at high-end tourism and culture. The trade-off is swapping the established high-volume liquidity of Dubai for a position in an emerging luxury hub. At the complete opposite end of the capital spectrum, Dubai has introduced regulations for tokenized real estate. This lowers the barrier to entry significantly. You can now buy fractional shares of the real estate market starting at just 1,000 dirhams. Micro-investing comes with strict limitations. You lose physical asset control, you can't use the property, and platform fees eat returns. The UAE market now covers both extremes. You can invest in a 100 billion dirham mega project, or you can participate with a 1,000 dirham fractional share. Success requires matching capital to the correct sector. Yield seekers wanting passive income should target Dubai's ready market for 9% returns. Patient optimizers chasing 10-year growth should deploy into Abu Dhabi or Al Maktoum off-plan corridors. Budget-conscious beginners can utilize 1,000 dirham tokenized assets. Regardless of your path, independent due diligence is mandatory. Do not rely on market speculation or outdated tactics from the boom years. Before any purchase, verify the developer's track record, evaluate the real timelines for the surrounding infrastructure, and make sure the projected rental performance is mathematically realistic. Rising supply creates a healthier, balanced system. The investors who win in 2026 will be those who replace blind buying with rigorous, goal-oriented asset selection.